Total Fund Portfolio Management Hub. Not because it is easy, but because it is hard. We are launching our pilot Thought Leadership Executive Series. Introduction to Integrated Total Fund Management with Mihail Garchev, former VP and Head of Total Fund Management at BCI. Hosted by Leo Kolivakis, publisher of Pension Pulse.
Good day, everybody. This is Mihail here again. It is this time of the week already, and what follows is episode 4 of the Introduction to Integrated Total Fund Management Executive Series. For those of you who are watching the series for the first time, this is a quick look at the topics we're covering in this 7-episode series. From episode 1 through episode 4 today, we will cover the foundation of total fund management. In episode 5, we will illustrate some of the topics discussed so far with a number of case studies. In episode 6, we will discuss what is required to move from a process and a framework to a capability. We will conclude the series with episode 7, where we will discuss the role of total fund management as part of the next stage of development of the Canadian pension model. In episode 3 last week, we introduced the roadmap of the series, which helps us navigate through the wealth of topics already discussed in almost 300 pages and 3 hours of presentation material. The roadmap is based on the organizational and investment beliefs which determine the strategy and objectives. We discuss both in the first 3 episodes of the series. Today, we will start exploring how to implement total fund management, and we'll be looking at the framework and the process to underpin the beliefs and the strategy. Ultimately, it is not about total fund management itself. Total fund management is a means to an end, and this end is the Canadian Pension Model 2.0, which is intended to further extend the efficiency and effectiveness of the current model. As part of the roadmap, we organized all the various insights, conclusions, and concerns in a set of beliefs and corresponding strategies and objectives. A central part of the total fund management strategy and objective discussion is the path-dependent nature of the pension outcomes, which requires a corresponding allocation and management process. To this end, we encourage those who are new to the series to revisit specifically the conclusions of episode 2 and the fact that the long term is a series of short terms and requires the management of the path of the current achievable returns toward the long-term required returns. Based on the investment beliefs which were defined in the earlier episodes, in the previous episode 3, we illustrated how to think about the optimal objective of total fund management, borrowing examples and experiments from physics and computer programming. It is not about long or short-term investing, but it's about how fast or slow and safe one arrives at the final destination. We demonstrated that safe is an important consideration because pension clients today are more sensitive to negative outcomes than ever. In fact, there is a twice more sensitivity today than the late 90s. The optimal objective is also about what decisions one can make about the portfolio today, given what we know with certain probability about the future and the required outcomes. And this is really the path-dependent allocation and managing the current returns, or the current achievable returns, towards the long-term required returns. We also introduced the key notion of the term structure of expected returns, which is a quintessential for making path-dependent asset allocation decisions. We'll talk about it more next. At this point, many of you are probably asking the question, what is the difference between total fund management and the typical allocation approaches? Isn't this just a tactical asset allocation in disguise? And how does it compare to strategic asset allocation, for example, or all-weather approaches? The discussion next provides a highly visual comparison of the key attributes of these widely followed approaches. Let's start with defining the setup for this comparison. We will first define the time horizon aspect. We will start with the notion of today, and then we'll have 4 discrete time periods. With these time periods, we will review 4 commonly followed allocation approaches. We will look at 4 approaches: the typical strategic asset allocation, an approach which we called just be diversified, or something alongside, weather approach, although the two might be different. We'll look at tactical asset allocation, and finally we have total fund management. In each of the approaches, the goal is to understand what drives the decision for a particular asset mix taken today, and not in any of the following 4 periods. We will also show what is the role of these 4 periods in the decision taken today. Ultimately, everything we do today and in any other of the periods is to achieve an end objective. We discussed and described these end objectives in episodes 1 as outcomes related to the level of wealth, inflation protection, contribution risk, and liquidity, which ultimately impact the sustainability and affordability of a pension plan. For the purpose of this comparison, you can think of the end objective as maximizing the level of wealth in this particular case. In the case of strategic asset allocation, we can make the statement that we will be holding this asset mix today because we expect these average expected returns over the entire time horizon. So there is an explicit expectation of constant average expected returns throughout the investment horizon. Now let's look at the second case, which is the just be diversified type of allocation approach. In this approach, there are no explicit expected returns. This portfolio management approach is based on the belief that if one does not know anything about the future, it is best to be diversified. This thesis still implies that one knows something about the future. Actually, 2 things. It implies that one knows the future correlations of assets, and one also knows the future magnitude of the changes in assets' value, and the belief that there will always be a mean reversion to a known in advance mean. However, correlations are not a given. They are an artifact of evolving economic conditions and the headwinds and tailwinds of other technological, environmental, and socio-economic drivers. This is why themes are very important in the portfolio construction context, not only in an investment context. Given the extraordinary world of disruption, both technological, societal, environmental, regulatory, you name it, it would be even harder to know what these correlations would be. So it would be much harder to assume any stable asset relationships. The same goes for the magnitude. A disruption could swing fortunes of businesses, sectors, or economies overnight with a significant magnitude. As for the mean reversion, in a disruptive future, mean reversion might be even less likely. Structural changes might take place, even if temporary, but who knows for how long temporary is. Look at the globalization, travel, office, and many others. Things might get back to the mean, but who knows how long this will take. Or simply, the equilibrium mean might change at a different level. Also, the very definition of what the mean is might change as well. For example, many are observing the multi-year underperformance of value and the 60% down from the last peak. And the conclusion is that a reversal to the mean might be just around the corner. But it might be that the very way the value factor is defined might not be appropriate given the move to a content economy. Perhaps what was a counting metric proxy for value has changed, and does no longer express the underlying financial reality. So this is all to say that just be diversified, although all-weather approach effectively states that we don't know the expected returns, but we do know for sure the correlations and magnitude of asset class, absolute and relative deviations. Tactical asset allocation is a single period decision from today to tomorrow, and there is no direct consideration for the end objective. Finally, total fund management is a multi-period decision because we can have different expectations about the absolute and relative expected returns in each of the subsequent 4 periods. This is both different from strategic asset allocation, where we have constant absolute and relative expected returns throughout the horizon, and different from tactical asset allocation, where we have only one single period. So the statement we are effectively making about the asset allocation today is that we're going to hold this asset mix today because we expect these expected returns over the full horizon with certain probability. Or this is another definition of the path of returns. So far, we talked about what drives the asset allocation decision today, given any expectations or lack of such about tomorrow. Now, let's introduce the term structure of expected returns perspective on all these 4 allocation approaches. We're going to start with strategic asset allocation. So for SAA, the term structure of expected returns is flat, which reflects the constant average absolute and relative expected returns. I can see right away how some people might disagree with me. To be fair, typically the expected returns have a built-in path, which is often valuation-based for equities and currencies, or path of interest rates embedded in the expected returns. I have witnessed quite a few of these at the various places I've been, so let me tell you some insider insights on this process and why it's important to talk about it. Even if there are built-in paths of returns, many of these differences are smoothed out at the end so that it does not create any significant impact to the plan design. Just imagine this. If tomorrow the fund comes with a 0 or even worse, negative long-term expected returns on equities, what do you think would be the impact on the plan design? In this case, actuarial techniques and considerations would be used. And these would be either inflation assumptions or some margins for adverse deviation or any other decisions. And this is a very, very important governance point. Today, even if one has 100% confidence in a 0 or negative expected return for equities, these expected returns would cause a direct and visible impact on the plan design. This is very difficult to be accepted by the plan sponsors or beneficiaries, and often the effect is managed, in inverted commas, via actuarial techniques and assumptions. Thus, the investment perspective is overwhelmed by the plan design perspective and possibly disregarded. At this point, it all hinges on the hope and belief for a mean reversion within a reasonable time frame, so that the actuarial techniques would work. If there's no mean reversion, or it is a slow bleed, the ugly truth shows up and can no longer be masked. Also, sometimes the decision of which asset classes to include in the policy portfolio and by how much comes from the bottom up. Usually, some head of an asset class wants to initiate a new strategy or asset class, often because there is the ability to add value. This now gets into the question of compensation and benchmarks, but let's leave this for some other time. It could also be an area that the asset class wants to explore, or it is about internal politics, centers of gravity, and relevance. This might be a perfectly good argument, but it doesn't mean that the fact that an asset class can add relative value over the benchmark, and this is something that we called local optimality earlier in episode 1. So it doesn't mean that the fact that somebody can add this value on a standalone basis, given the asset class and the benchmark, is necessarily good for the fund, which is something that we called global optimality. It could be that although there is a distinctive case for adding relative value at the asset class level, however, the asset class may perform worse on an absolute basis or relative to other possible asset classes and strategies, so other alternatives. Also, sometimes clients need to approve a new product or an asset class. So the easiest way for this is to become a new asset class in the policy portfolio. More often than not, the bottom-up process wins, and the strategic asset allocation would need to find a way to incorporate the desired strategy in the asset mix to satisfy the intent. Finding a way, in inverted commas, may include creative correlations, volatility, or expected return assumptions, which would bring out the benefits of this addition to the asset mix. In this example, the investment perspective is overwhelmed by the bottom-up perspective. Both these examples of the investment perspective being overwhelmed by the plan design perspective or the bottom-up perspective could be viewed as an examples of the hidden costs we discussed in episode 1, which ultimately lead to diminishing economies of scale. There is a more elegant and flexible way, which is to keep the outcomes constant. These wealth, inflation, contribution, risk, and liquidity via an outcome-oriented policy portfolio, which is, remember, no asset classes, but outcomes, and adjust the actual asset mix in a way it would make sense solely from an investment perspective. Also, instead of having a bottom-up pushed activity as an asset class before it is even ready to be implemented, it is probably a better idea to have an investment incubator to explore things before really ready to graduate as a fully implemented strategy or an asset class. It would be transparent, built for purpose, an accountable process with clear costs and benefits. We spent quite a bit of time on strategic asset allocation, but it is important to understand how things work in real life and what are the constraints of this approach. In the case of just be diversified approach, there are no explicit returns, so there's no term structure. Tactical asset allocation considers the single period best outcome, not the sequence of outcomes across all the periods. You might ask, if we always choose the best single period path, wouldn't this lead to the best outcome? As we will see in the upcoming episode 5 with the case studies, just using each single period's best path does not lead to the most optimal decision today. And finally, total fund management makes the most optimal decision today based on a multi-period basis, which is the complete term structure of expected returns. Finally, let's see how the 4 approaches differ based on when the decisions are being made. Strategic asset allocation typically has a 3-year review cycle. However, there could be possible interim updates over 12 or 18 months. If the world doesn't change too much, this might be okay, but certainly not in a very dynamic and challenging environment we are seeing today and expecting in the future. In the case of just be diversified portfolio approach, a decision is typically made in the beginning, but could change allocation or add new asset classes at any time whenever there is an argument to do so. In the case of tactical asset allocation, decisions are made each period on a one period ahead basis. Finally, for total fund management, decisions are made each period. However, these decisions are on a multi-period ahead basis. So at any period, the decision considers the complete term structure of expected returns. And this is very, very different from tactical asset allocation, where we, again, have decisions every single period, but these decisions take into account only one period ahead instead of the complete term structure of expected returns. To reinforce the last point, let's put it all together. So let's look at total fund management case and combine the notion of the term structure of expected returns with the decision points view. So in this case, we have a period one decision, and we have the term structure of expected returns for total fund management. And for the decision today, we're discounting the expected returns at the different points in the term structure using a path-dependent algorithm. And this is referring to, if you remember, the physics and the Rome experiments in episode 3. So discounting the term structure of expected returns with the path-dependent function allows us to determine the best portfolio we can hold today, which maximizes the end objective. Then, in period 2, we rinse and repeat, so to speak. Again, we just move the slider, and again, we discount the new term structure of expected returns at period 2 with a path-dependent function to determine the best allocation that would maximize the end objective. And we do the same thing in period 3 and in period 4, and so on and so on. This slide summarizes all the key points from the visual examples and the comparison between the 4 approaches. In a nutshell, strategic asset allocation makes a decision about the asset mix today based on average expected returns over the entire horizon, and in doing so, it considers the end objective explicitly. The process usually incorporates some path dependence based on valuation and interest rates. Oftentimes, however, the outcomes are smooth, using various actuarial assumptions and techniques to limit unfavorable impact on the plan design. Decisions are made on a triennial review cycle with possible updates in between. Just be diversified or the all-weather type of approaches. They have no expectation on the expected returns, but they assume knowledge of the correlations and the magnitude of asset class absolute and relative deviations, as well as they incorporate a belief in the reversion to the mean. In doing so, they still consider the end objective explicitly. Decisions about the asset mix are made in the beginning, but could change any time, either allocation or adding new asset classes whenever there is an argument to do so. Tactical asset allocation is a single period decision-making process. So it makes the decision each period on a one period ahead basis. It does not consider the end objective, and this is a very big difference compared to the other approaches. Also, it's important to understand that making the best single period decision does not mean that the end objective will be optimal. Finally, total fund management. The decisions are made each period, or there is, in a way, a continuous assessment, but these decisions are made on a multi-period ahead basis, or the complete term structure of expected returns. And also, this is all considered because of the optimal end objective. So it manages towards outcomes and uses an outcome-oriented policy portfolio. And as such, it does not compromise the investment objective for any plan design or bottom-up or other objectives. As such, it avoids the hidden cost of potentially suboptimal allocations. Discussing the difference in the allocation approaches and the role of the term structure of expected returns clears the way to introduce the topic of total fund management implementation and its first two elements, a framework and a process. Remember, we started episode 1 with a slide that was illustrating that there's no textbook and no blueprint of how to do total fund management. Now that we went through 300 pages and 3 hours of presenting the foundation of total fund management, it is time to talk about implementation. So let's close the textbook and look at the blueprints, or how to develop a total portfolio management framework and process. Based on everything we discussed so far, we can define 4 key objectives of the total fund management investment process and the corresponding strategies to accomplish these objectives. At the end of the day, all boils down to the ability of managing the winding road. So the first element is the path-dependent allocation. And to do this, one needs a process which is similar to strategic tilting, or you can find other ways of naming this. The second element is the efficient portfolio maintenance, or balancing the cost of maintaining the portfolio with the risk of this portfolio deviating from its original version, as well as the return which could be gained or sacrificed by doing so. Or in a nutshell, this is very much related to portfolio rebalancing as a strategy to implement an efficient portfolio maintenance. The next 2 elements are very much related, and they are the ability to manage downside risk, as well as proper liquidity and contingency management. And both liquidity and contingency could be related to managing downside risk, but also related to efficient portfolio maintenance. And when we're talking about liquidity and contingency, there's a broader spectrum of activities that actually fall underneath this, which starts with the very top of it, which is efficient balance sheet management, then leverage as part of it, then liquidity, and the ultimate source of liquidity, which is contingency. And broadly speaking, the process that, or the strategy to accomplish this objective, or the process, is some form of a risk mitigation portfolio protocol. Let's now zoom out and outline some key aspects related to the 3 strategies we just identified to accomplish the 4 initial objectives. The first one is portfolio rebalancing. And portfolio rebalancing is most efficient as a portfolio maintenance in normal market conditions. However, portfolio rebalancing is suboptimal when there is a pronounced trend, whether a market downturn or a bull market. In a market downturn, what becomes important is managing everything that's related to the balance sheet, the leverage, the liquidity, and ultimately the contingency. And this needs to be done within a structured risk mitigation portfolio protocol, which includes monitoring and dynamic downside protection, ability to have critical stress signals, and planned crisis asset allocation and liquidity contingency. On the flip side, in strong market conditions, what one needs is some form of a strategic tilting or any form of a psycho and valuation type of allocation. And what is also important is to optimize the leverage and the balance sheet in these conditions as well. We will look at some examples and case studies related to these strategies in episode 5. At the end of the day, to do all this, one needs a structured process which integrates market liquidity and economic conditions with valuations to arrive at expected returns and risk conditions at the short and medium-term horizon. We'll look at this process next. This is the core of the total portfolio process. It starts with the portfolio exposures. The second element is the ability to have a macro and market valuation framework. The third one is the portfolio diagnostic. And the fourth one is when it all comes to making investment decisions. Nothing could be accomplished without portfolio exposures. As simple as it may sound, a key aspect is the timely and accurate reporting on key attributes, be it country, region, sector, duration, credit, and so on and so forth. Factors are great, and there's been a lot of focus over the last 10 years, but it is important to be clear how exactly factors fit in the investment process. Just having them for their own sake is nice to have, but probably of limited investment use from a total fund management perspective. This is not to say that one cannot design an investment strategy based on factors. In fact, most active managers do that, whether they admit it or not. What I'm talking about here is to have a very clear understanding of what factors are and how they fit in the total fund context rather than as a standalone strategy. And of course, it's nice to have style and factor exposures, but this needs to be done only after there is a strong foundation for the very basic but timely and accurate key exposure reporting. Thematic exposures, so probably less in the past, but thematic exposures are becoming increasingly important for total fund management, given the disruptive nature of the world today, as they may be a headwind or a tailwind to the conclusions from a broader macro and market assessments. The second element of the investment process is the most critical one, because it allows you to link assets to markets and develop absolute and relative expected returns for these assets at different horizons, which is then the basis for the term structure of expected returns. And at different horizons, asset returns are driven by different forces. Short-term returns are heavily driven by economic and market indicators related to liquidity and sentiment. At the short to medium term, asset returns are driven primarily by business credit and monetary cycle conditions, and including the tailwind from valuations. These are effectively indicators and signals which have a 6 to 12 months lead time to asset returns. At the medium-term horizon, or 3 to 5 years, returns are largely driven by valuation. To be able to do this in a consistent manner across different markets and asset classes and capital structure, there is a need for a consistent methodology. Probably the best choice in this respect would be some form based on the combination of income, growth, and valuation, as this combination could be consistently applied across various asset classes at this horizon. The topic of valuation is a widely discussed one, especially as it applies to equities, and with many variations. It is a topic on its own, that's for sure, but it's not the purpose of this presentation to get into details and discuss it. The topic of valuation also exists for other asset classes. So, for example, for bonds, It is often related to the shape of the forward curves, the row returns, the valuation and duration adjustments, through the cycle inflation, among others. For credit, it will be the spread rows, the probability of default, rating transitions, optionality, liquidity, and so on and so forth. For currency, it would be swap rates, labor market productivity, external sustainability, various other valuation approaches. What is important is to have all these expected returns consistently estimated with the same inputs that are used for the other measures, and also to be estimated in hedged, in currency hedged, unhedged, or in local currency terms, and be easily transferable in any currency, as well as in real and nominal terms. So to do all this, one needs to use the same inputs across the whole system. It also needs to allow for scenario shocks, so changes to parameters, equilibrium values, level of stress, duration, as well as having risk inputs. And finally, at the 10 plus year horizon, expected returns are widely covered, and these are the backbone of the strategic asset allocation process. We will not talk much about it, except for saying that in many cases, it's a combination of deviation from long-term equilibrium, whatever these equilibria are assumed to be, as well as some tailwind from valuation. Now, there is an additional aspect of the expected returns that needs to be considered, and these would be the themes. Because as mentioned earlier, themes could act as a headwind or a tailwind to the macro or the market signal, and they may actually impact different horizons as well. So you can have multi-cycle themes, which are kind of mega super cycle trends that play on structural drivers of change. Then you might have cyclical themes, which in which cases the returns are typically dominated by 2 or 3 themes, and which are seldom repeated in consecutive cycles. And then you can have within cycle themes, typically early, late, or mid-cycle plays and impacts. And these could have sometimes significant impact on the final expected return. So although the market and the macro might be suggesting a certain expected return, the impact of theme could amplify or negate the impact of market and macro. So as a final point on the expected returns and the framework, the macro and market framework to estimate these absolute and relative expected returns at different horizons. And this final point is that these expected returns need to be based on signals and indicators which satisfy a number of requirements. First, there has to be a theoretical relationship, something that's it's not just a statistical finding, but it's something that has intuitive and theoretical relationship, and typically it's linked to asset risk premiums. Also, the expected returns derived from these signals and indicators need to satisfy certain quality conditions. So they need to show outperformance certainly in back tests, in properly designed back tests. They have to have a lead time. They have to have persistence, frequency, and direction agreement as well. And also another one is the strength. So the strength of the signal. So the signal can exist only at extremes. What's the breadth of the signal? What is the strength? And are these signals agreeing directionally across multiple asset universes? So there are a number of these things that need to be not only the consistency, not only how exactly you estimate these expected returns, but also a number of requirements, how these expected returns are derived. Another requirement is that the expected returns need to be available for any single market across time or across markets at a given point in time. And it's also important to note that the value of expected returns is stronger in relative rather than in absolute terms. And the expected returns need to be standardized across all assets and markets. Now, we mentioned that the macro and market framework is the most critical part in the investment process. The reason for this is that a properly designed macro and market framework would allow you to develop the term structure of expected returns. And as we saw, the term structure of expected returns is a central requirement for a path-dependent total portfolio allocation process. And in addition, if the macro and market framework is properly designed, the conclusions about the assets themselves, both in absolute and relative terms, as well as the ability to link these assets to the macro and market conditions via indicators or signals, would effectively allow you to develop a number of risk matrices which describe market and economic conditions. And these risk matrices are complementary to the expected returns, and they provide a more aggregate view of the state of the market and what drives this state. But importantly, again, if this framework is properly designed, you would be able to look at these risk matrices by different asset classes. You'll be able to look at it by different country, regions, or different geographic aspect, different time horizons. So it could be a short-term market conditions or medium-term market conditions. And also, you'll be able to see this by economic or market drivers or themes as well, or any combination of these for that matter. So the key output of the macro and market framework is really the term structure of the expected returns and the accompanying risk matrices, which reflect different sides of the market and economic conditions, and the ability to quickly change the perspective from asset class to country to horizon or specific drivers. The third element of the investment process is the portfolio diagnostic, or this is the ability to evaluate the portfolio, the current portfolio, versus the expected returns and the risk matrices which are derived from the macro and market framework. So in visual way, once you know what your exposures are in the portfolio, then you know what the market conditions are and what it means for the expected returns. then the product of all this is the ability to actually diagnose the portfolio. If we are to illustrate this a little bit further, given the expected returns and the risk matrices at the different time horizons, so the term structure of expected returns and the market condition, the risk matrices, this would allow us to evaluate the portfolio efficiency. So the first question we could answer is, given these expected returns and market conditions, what will be the aggregate portfolio expected return and exposure to these market conditions? And then what changes to the portfolio are needed to maximize the end outcome probability? And this now leads into the ability to make decisions, which we'll talk about next. The ultimate goal of going through all this pain in the investment process is the ability to make decisions, or the ability for the investment committee to make decisions. And we can think about this decision-making process as an integrated process of inputs which lead to outputs. And important inputs in the decision-making is first the ability to clearly articulate the nature of the decision. So what exactly are we deciding on? Then the second step is to gather all the relevant information, whether it's internal, external, past experiences, then to identify possible paths of action or other alternatives. Then comes the element of weighing in the evidence, whether it's data-driven, discretionary, look at probabilities and confidence levels, and importantly, detect biases, which may be related to the decisions, and be very clear about these. So these are some key inputs, and the investment process needs to be able to support these inputs or provide information, or at least to facilitate these inputs. And on the other side of this integrated process are the outputs. So arriving at a decision based on the inputs, that's the first step. Then it's important to be clear and to be able to evaluate the consequences of this decision, and see whether this decision still holds. Then it's the usual step of taking action. And then the feedback loop of evaluating results and looping back to the initial need and seeing whether the action and the decision and the action led to achieving what was the need in the first place. The next point is about the need, why there is a need for a structured and disciplined process at the investment committee. And the reason for this is that in many cases, you can observe investment committees, even at some of the large funds for that matter, that don't necessarily have such a structured and disciplined process. And by virtue of this, a lot of decisions are ad hoc decisions. And no matter what people may say in public, but ad hoc decisions are typically made only when it's only in stress market conditions. So when it's about, figuratively speaking, it's about the return of capital, rather than return on capital. So it's about, preserving capital rather than any return on this capital. And this is a problem because this means that a lot of the potential efficiency that would be embedded in the total fund management process won't be necessarily realized. And therefore, it becomes, again, one of these hidden costs that weigh on the efficiency and the effectiveness of the Canadian pension model. So the fact that there's no structured and disciplined process at the investment committee is an implicit hidden cost to the efficiency of the fund. This is why there is a need for an investment process. Now, sure, an investment process is needed, but it has to be structured and disciplined, and most probably data-driven as well, rather than just a discretionary one. And the reason for this is that there is, as everybody knows, there is an information overload. There's too much data and too much noise as well. And it's difficult to know where to focus the energy and time. Also, having proper process, both structured and disciplined, but also data-driven, safeguards against cognitive biases. So subconsciously making selective use of data, or even feeling pressure to decide by more powerful or more knowledgeable peers at the investment committee. And ultimately, it's also about accountability and the ability to follow up, but also the ability to look back and look at good decisions and bad decisions and create this evolutionary process of learning from mistakes, and certainly probably making new mistakes as well. This next slide further reinforces the notion for the need for a data-driven investment process, in addition to any discretionary aspects. And it has a little bit of market trivia. It's certainly an interesting fact, but also there's something to think about what it means in the broader aspect of decision-making. So a Hong Kong venture capital fund appointed some time ago a computer algorithm to its board of directors. And so they gave the machine an equal vote when it comes to investment decisions. And apart from the fun fact, there's some important things to keep in mind when it comes to the investment process and decision making. So the first one is the healthy tension. So the ability to complement discretionary thinking with objective facts and conclusions based on a multitude of confirming or contradicting signals. So this is very healthy for the investment process. Another aspect is the fact that door locks are to keep honest people honest, or to translate this into the investment decision-making aspect. So this is equivalent to having decision model portfolios running in parallel, which will allow to learn from past decisions and circumstances and keeping honest people honest. And finally, it's about accountability and the old adage, which we repeated quite a few times already, that what is measured is managed. We had to do this little detour talking about the investment decision process in more general terms, because it is important to evaluate how the previous steps, so the steps of the exposures, the macro and market framework, and the portfolio diagnostic, actually support these fundamental requirements for the investment decision process. And now that we've covered this topic, let's zoom back in on how the market framework, the macro market framework that we described a bit earlier, how it supports specific investment portfolio decisions at the total fund. So, based on a properly designed macro and market framework and proper portfolio diagnostic, which is the next step from the framework, and it's certainly linked to it, depending on how it's designed, then the total fund process would be able to make a number of key decisions. And these decisions are related. So the first one is related to the ability to define risk on and risk off conditions, and effectively being able to dial up or down the overall beta risk of the fund. And not only the overall beta risk, but also the beta risk in different slices of the portfolio, depending on the diagnostic of the portfolio. And this relates to the second question, which is, what are the relative beta opportunities, and in which cases active risk could be also increased as well, in addition to the beta risk on, risk off. So answering questions, which opportunities are we missing? Which is the best path to take to maximize the end outcome probability? So what are other alternatives to do this? And also these considerations trickle down to more basic, fundamental rather processes of total portfolio, such as rebalancing or currency hedging, for example, among others. The conclusions from the portfolio diagnostic also provide the ability to make portfolio decisions related to the risk, not only to the opportunities, but to the risks in the portfolio. So what risks to remove or what risks to hedge. So what are these risks given the conclusions from the expected returns and the conclusions from the related risk matrices? So what are the main risks in the portfolio? So how is the portfolio exposed to these risks? How do we mitigate these risks? Can we turn them into opportunities? Should we dial up or dial down active risk as well? A lot of other decisions are required in the total portfolio. And these decisions are, again, related ultimately to being able to articulate market conditions through the risk matrices, but also the ability to articulate absolute and relative expected returns as well, because this can give guidance whether to increase or decrease liquidity, where and how to take leverage, and how to optimize the balance sheet as well. And these, of course, are all could very well interrelated. And ultimately, being able to integrate themes in the macro and market framework and the subsequent portfolio diagnostic is also very important, because as we mentioned earlier, being cognizant of themes and even further being able to integrate these themes into the decision-making process will become more and more important. It's certainly important today, but will become even more important going forward. And these are all questions related to, are these themes or event risks in development, how these themes could change the conclusions from the macro and market assessment. And it's also the ability to integrate these not only in a discretionary manner, but in something that's more systematic, if you wish, or more data driven and structured and disciplined. This is now just an illustration of the previous slide, and visualizing the fact that once one knows with a certain probability the term structure of expected returns, as well as the market and the economic conditions, and all this information being compressed into these two key notions, allows for making different decisions in different investment processes, being using short-term returns and short-term market conditions to determine rebalancing decisions. And we'll look at this in the case studies in more detail, but effectively using elements of the expected returns and elements of the risk matrices, which reflect the market economic conditions, and translate this into a process for the rebalancing and arriving at rebalancing decisions. At the same time, these conclusions, especially at the shorter term, are also very important for any balance sheet or liquidity conclusions as well, which are attached at the hip to the rebalancing process. And again, we'll illustrate this in one of the case studies in episode 5. But also short-term expected returns and risk matrices are also related to any risk mitigation portfolio protocol through various elements, and support such a risk mitigation portfolio protocol, but also support critical decisions about again, leverage, about liquidity, about contingency and balance sheet as well. On the flip side, in different market conditions, in stronger market conditions, decisions around the short to medium term and the medium term as well, which are more business cycle and valuation and fair value driven, allow to define the optimal path to maximize the probability of the end objective. So it supports the ability to make these path-dependent allocation decisions, but also support decisions around taking leverage, where exactly to take the leverage, in which asset classes, and also how to optimize the balance sheet as well. And if everything is estimated in a consistent manner, and we mentioned this a couple of times already when we discussed the market and macro framework, it's also linked at the longer end to the inputs in the client's policy portfolio or the strategic asset allocation piece of the investment process. So this is just an illustration of how everything is linked, and how term structure of expected returns and the supporting risk matrices are critical elements to be able to do this. And again, do this not in an ad hoc discretionary manner, but as part of a structured and disciplined data-driven process. So for the first time in the series, we are now able to articulate and visualize the total fund management integrated investment process. So this investment process has at its core has the 4 elements of the decision making. So exposures, macro and market framework, portfolio diagnostic, and decision making, all the elements that we discussed so far. So this is the core of the process, but there are a number of satellite total fund investment processes which are linked and which draw conclusions from the core investment process. And these processes, we've mentioned them a couple of times already throughout the series, but here is the first time we put them all on one page in an integrated manner. So these are the rebalancing decision, risk mitigation, anything that's related to strategic tilting or any path allocation, path-dependent allocation, currency hedging, active risk, balance sheet leverage, and liquidity as well. And what's important is that all these decisions are made in in an integrated fashion. So not just making a rebalancing decision and undoing it through some currency hedging decision or through some liquidity decision or deciding on a risk mitigation decision, but then offsetting it by some other decision. And it's also a consideration of cost benefit of doing one through the other. So for example, if the decision is to hedge because of exposures, what's going on in the markets, the portfolio diagnostic, the decision is to hedge, let's say, equity risk, then the decision needs to be carefully weighed whether this is done through a risk mitigation mechanism, be it, let's say, some form of portfolio insurance, or this could be done through the rebalancing just by increasing the cash allocation, which in certain cases could be an equivalent option, could be seen as an equivalent option position. Or this could be done through the cross hedging properties of the currencies. And again, which way it's implemented is also a question of what is the impact of the decision or the magnitude of the impact, but also what's the cost of this decision, because it might be 100% impact through the portfolio insurance mechanism, but it's very costly. Or it could be 80% impact through rebalancing, but it's very cheap as a direct cost, but there's a hidden opportunity cost in it. And the same for currency hedging. So it's the ability to actually not only being able to articulate these decisions, but also weigh the cost benefit of these decisions as well. And this is what really a CIO needs to be able to implement a total fund management process. And again, this total fund management process is not because it's nice to have, this wheel to steer the ship, so to speak. But ultimately, remember that it's all about being able to bring these secondary efficiency to the fund, rather than just a self-centered process on its own. Being able to bring these second-order efficiencies to the fund, to extend the economies of scale, rather than just having total fund management as a self-centered process on its own. It is a good time now to pause and zoom out and visualize in a slightly different way the roadmap that we discussed in detail in the previous episode, and visualize it through the steps we need to take to move from investment beliefs to actual implementation. So this is really a lot of the things that we discussed so far put on a two-dimensional map. So it all started with what is sustainability about, and we said that it's about managing returns and liquidity, and not only returns but required versus achievable returns. And this is all linked to the fact that the long term is a series of short terms, and the ability to manage the path of the short terms in conjunction with the required and achievable returns is effectively the ability to manage the strategic sustainability risk of the fund. And this requires to have a path-dependent allocation, to have a risk mitigation and contingency aspect to it, manage liquidity, leverage, and balance sheet, and having an efficient portfolio maintenance, which are also related to minimizing cost. And to do all this, one needs a number of strategies which are related to either rebalancing, a risk mitigation protocol, or some form of a strategic tilting. And again, this all in conjunction with the balance sheet, liquidity, leverage, and contingency. And these need to be integrated in a total fund process, which has the four core elements, which is exposures, macro and market framework, portfolio diagnostic, and a decision-making process. And the key, or the critical aspect of this core process is the macro and market framework, which is effectively the ability to integrate absolute and relative expected returns at different time horizons, and also integrating themes into this, which ultimately allows us to articulate a term structure of expected returns accompanied by market and economic conditions, or these risk matrices that we described, which have different ability to look at different aspects of these conditions, whether different short or medium term, by asset class, by geography, or by drivers, economic or market or thematic drivers for that matter. And now this gets back as a feedback loop into the investment strategies that are used by the fund. Again, rebalancing, strategic tilting, risk mitigation, or various cash and leverage decisions. And this feeds back into the satellite investment, total fund investment activities. And we described some of these, being rebalancing, currency hedging, active risk, and so on and so forth. So this is, in a way, our map of the road to the proverbial city of Rome. It starts with the understanding of what matters for the portfolio sustainability and wealth maximization. The fact that one needs to manage both the short-term and the negative outcomes and have an efficient implementation. We describe the key elements of the framework and the importance of expected returns, and finally, the elements of the total fund investment process. But how one implements all this, and is total fund management the end goal, or just the means to an end of something bigger and better? So these are the key takeaways from today's episode: how to develop a total fund framework and process. So the first takeaway is that total fund is very different from strategic asset allocation, any all-weather diversification approach, or tactical asset allocation. Total fund management critically relies on the ability to formulate expected returns at different time horizons, or this term structure of expected returns, as we called it. And it's the path dependence that is its distinct feature that separates it from all the other approaches and allows it to actually function. At its core, the total fund management process is about the ability to formulate absolute and relative expected returns at different time horizons as part of a consistent and coherent macro and market framework. The evaluation of the total fund exposures, given the expected returns and the market conditions, or what we call risk matrices, allows for making key total fund decisions. Total fund decision making, however, requires a structured and disciplined, data-driven process. This concludes episode 4 for today. In episode 5 next Thursday, we will provide several case studies to illustrate key total fund management applications and decision processes. Stay tuned and stay safe. And thank you for staying with us today.
Total Fund Portfolio Management Hub. Not because it is easy, but because it is hard. Thank you, and see you at the Pension Pulse blogspot.